Yeah, it's going to take some time. I mean, firstly, if we look at the oil market, our view is with the extension of the production cut deal, we're going to see that transition from surplus to deficit brought forward from about August, September to July. But I really think, when does the market really fully digest all that inventory build? And we really think it's only sort of as we get into late mid next year that the market would have digested a large part of that inventory build. So I think in terms of price, yes, you can be constructive, but we just need to keep in mind that that significant level of inventory that's hanging over the market.
Warren, very good morning to you. I want to talk about demand. You would have seen also the China crude oil import rebound to a near record 11.1 million barrels a day in May. That's an increase of 13% from April. That is quite a stunning rebound there. So I want to talk about demand with that in mind, and also these comments that we've heard from Novak over the last few days, that he thinks that the supply-demand imbalance could move to a supply deficit in the next month or so. I just wonder what you thought about the demand side of the equation.
Yeah, so absolutely, we saw record imports in China over the month of over May. But the big question is that real consumption, or are we seeing opportunistic buying from Chinese refiners? And my view is it is the latter. They've taken advantage of the lower prices we've seen over the last couple of months in order to stock up on oil. And then, yeah, I would have to agree with Novak's comments about the market shifting from that surplus environment to deficit. With the latest deal, our view is that it will happen in July. Now, one word of caution is obviously, if we look at the rally we've seen in crude oil prices, it has been amazing. But the big question mark, well, the big uncertainty is if you look at refinery margins. Refinery margins are very weak across the board or across all regions. And that does sort of suggest that maybe demand's not recovering as quickly as many had anticipated, or at least it's not keeping up with the move higher that we've seen in crude oil prices. And obviously, what's not helped that is the fact that over the weekend we also got the Saudis increasing their official selling prices for July. So again, further hitting refining margins.
So add all that together with the fact that a lot of IOCs are turning around saying, do you know what, it's just not worth our while anymore producing crude oil. We're going to transfer our capital expenditure to more alternative-friendly, energy transition-friendly sources of fuel as well. And are we going to see long-term structural changes to the complex, or is it the same old, when it's low, we turn the taps off, and when it's high, we put them back on again? What's going to be different this time?
Again, I think it is going to. I don't see how different it's going to be. Yes, obviously, we've seen a massive cut in capex, so that does suggest that we could see significantly higher oil prices in the years ahead, which could sort of push that energy transition agenda. But at least in the near term, short term, I think the fact that we're already seeing some U.S. producers saying, well, we're going to bring in shut-in wells back online, it does show you the flexibility that the industry in the U.S. has, so that they can respond fairly quickly to market dynamics. So yeah, I think in the short term, not much changes, but definitely in the longer term, it does speed up energy transition, we believe.